All right, hi, and thank you for coming tonight. I'm going to talk to you a little bit about estate and tax planning tips. But before I do, I'm going to give you a little bit of a background on who I am, where I came from. Right now, I teach at Albany Law School. I teach in the clinic, so I teach in the tax clinic. I teach students how to be lawyers by representing individuals that have tax problems with the IRS and with New York State Tax and Finance. So I'm a New York attorney. I'm not a Massachusetts attorney, although I did take a look last night as I was preparing at the major differences between New York and Massachusetts law. But I've been there for 5 years. I also teach trust and estates, financial planning for the elderly, intro to tax, and some various courses here and there. But prior to coming to the law school, I worked down in New York City doing trust and estate work, and up here in a financial services firm and in a law firm doing income tax planning, trust and estates planning, and all that type of related work. So this type of discussion is really my passion, and I'm going to cover an enormous amount of material in 40 minutes. So I don't expect anybody to walk out of here with any sort of mastery of this information, but hopefully you'll walk out of here with just some food for thought, and it'll give you some questions to ask as you go forward in your planning. So the first thing I'm going to talk about is the American Taxpayer Relief Act of 2012. And a lot of what I'm going to talk about is going to relate to taxes, because the more you know about taxes, I think the better off you are. People are afraid to talk about taxes. People are afraid to think about taxes, but it's really not that difficult in many respects if you can just not be afraid to ask the questions and to think about it. So in January, as you know, so that we didn't go off the fiscal cliff, there was a lot of discussion of this new tax bill that was passed in the beginning of January, and it has a lot of real-world implications for all of us in our everyday lives. So there's some income tax considerations that I'm going to go through, and also some estate tax considerations. And then I'm going to kind of dial it back and talk about how these tax considerations apply to an estate plan, but also I'm going to talk about some non-tax considerations. So a couple things happened back in January. The top income tax bracket increased from 35 to 39.6%, and you can see the numbers here on income exceeding $450,000 for couples and $400,000 for individuals. And we all know now that for tax purposes, couples include same-sex and opposite-sex marriages, and that was as a result of the Windsor decision by the Supreme Court over the summer. Capital gain and dividend tax rates for taxpayers with income over $400,000 or $450,000 will increase from 15 to 20%. Otherwise, the rates are going to stay the same. So capital gains tax applies, for example, when you sell a house, right? You may have a capital gain on the sale of your house, and also if you have dividends from any investments that you have, these are the rates that are going to apply to that. But just as an aside, if you sell your house, there's a little exclusion in the Internal Revenue Code under Section 121 where you can exclude up to for individuals, 250% of the gain on the sale of your house, or $500,000 if you're married and file a joint tax return. So that helps with these capital gains tax rates. And just in case you don't know, and I'll assume you don't for just talking this through, capital gain is when, say, you buy your house for $100,000 and you sell it for $200,000 without anything in the middle. There's some complications to it, but the capital gains tax is going to apply to that $100,000 of gain. So these are the rates that are going to apply. And there's all sorts of nuances, of course, but just to get the general concepts out there. Personal exemptions and itemized deductions are going to be phased out for individuals with income exceeding $300,000 for couples and $250,000 for individuals. So personal exemptions are the exemptions amount that we each get. So on your tax return, it's about $3,500 for an exemption, And itemized deductions are things like mortgage interest, taxes, state and local taxes, all your charitable contributions and things like that that actually go on Schedule A of a tax return. And then the alternative minimum tax exemption is going to be indexed for inflation. And that's that ugly tax that if you have a certain level of income and a certain level of deductions, you're going to get whacked with an additional tax, which is called the alternative minimum tax. There's a couple of other income tax considerations that you should be aware of. And there's a 3.8% Medicare tax that just came into existence with this new law. And so if your net investment income, if your adjusted gross income exceeds $250,000 for couples or $200,000 for individuals, there's going to be an additional 3.8% tax on net investment income. So hopefully if you took Dave's investment advice, you'll have some of that, and investment income is going to apply to, qualified dividend or dividends, capital gains tax, and in that type of ordinary investment income. And this produces a top federal rate for certain people of 43.4% when it comes to investment income, and for 23.8% on qualified dividends and capital gains. So it's just something to be aware of. So for example, my mom and dad just sold their house on Long Island and moved to Florida, and they owned a house in Rockville Center on Long Island, which is a decent area on Long Island, and they didn't have a mortgage, and they were all kind of concerned about this 3.8% tax. And that 121 exclusion that I mentioned, that capital gains tax exclusion, helped eliminate that, but they also didn't have other income that brought their income up to $250,000. So it didn't apply. But just think of that if you are selling a house and if you have other income that's being generated every year, that you may be subject to this additional 3.8% tax. In 2012 and in 2013, we heard a little bit about the payments that need to be made for an individual from a retirement account after you reach the age of 70 and a half. But an individual in 2012 and 13 may roll over up to $100,000 from his or her IRA directly to a qualified charity and not have to pay the income associated with that distribution. So that's just for 2012 and 2013, and that exception's been used quite readily in the income tax and charitable planning by individuals. So it's just something to know of for these 2 years. So if this is something that would apply to you or somebody that you know, you may want to go talk to somebody about doing this by the end of 2013, which, believe it or not, is rapidly approaching us. And you all may have seen your paychecks go up a little bit because that 2% cut that we had in the Social Security tax has been eliminated. So you can see that's the guy kind of sitting over his bills, but that was not extended. So we're going to see that's gone away. Estate tax considerations. The estate gift and generation skipping transfer tax, and it, has been made permanent, the exemption. So now we're at a $5 million exemption federally for each individual. So if you die with assets that do not reach the $5 million mark, you don't have to worry about federal estate tax. In fact, it's indexed for inflation, so this year it's $5,250,000. But you still have to think about state estate tax, right? So in New York, our estate tax exemption is not coupled with the federal estate tax exemption. So if you die in New York with a gross estate in excess of $1 million, you have to think about estate tax planning for New York State. And I took a look last night, and if there's anybody in here that can correct me, Massachusetts also seems to have, unless it's changed, a $1 million exemption, just like New York as well. Estates can get up to $1 million quite quickly, and I'm going to explain what's included in an estate for that number in just a little bit. And then you can see the transfer tax rates is fixed at 40%. And I'm going to go through in more detail a little bit what's included in a gross estate in just a little bit. One of the estate tax considerations in this new bill is, I said that there's a $5 million exemption for per individual. Now we have something called portability. So for married couples, it's actually $10 million. So just say one, the first spouse to die has an estate of $2 million and doesn't use up his or her entire $5 million federal estate tax exemption. If the surviving spouse dies with more than $5 million, they can use the remaining $3 million in my example to shield his or her assets from federal estate tax. So before, as planners, what we had to do was we had to kind of equalize people's estates, right? So that we could take advantage of each person's federal estate tax exemption or each spouse's. But now that's not so relevant because we have what's called portability and we can carry it over. But if the surviving spouse remarries, you're out of luck, right? So you have to think about those types of considerations. So the portability is actually revoked in that situation. And of course, like I said, I don't expect everybody to walk out of here as an expert in this type of thing, but if these kind of topics, if these concepts resonate and stick with you, it'll help to make some decisions later on. And if anybody has any questions, please interrupt me at any point. All right, so putting the estate tax stuff and all the income tax stuff aside, I just wanted to kind of go through some of the tax and non-tax considerations in estate planning, because not everybody is going to have assets that rise to the level of the federal estate tax exemption or the state tax exemption, but that doesn't mean that you shouldn't think about creating a will and to create some other of the documents that I'm going to talk about that comprise an estate plan. So I have a slide here that says, who needs estate planning? And believe it or not, all of you already have an estate plan if you don't have a will. And that's called the intestate succession statutes in Massachusetts, or if you live in New York. So somebody has already decided how your assets are going to be distributed if you don't have a will. So if you don't like what somebody has decided, you should take matters into your own hands and make those decisions for yourself. And I'll tell you a little story about this. I practiced in New York when September 11th happened. And I did a lot of volunteer work for a local firehouse who lost 8 of their firemen in the trade centers. And not one of them had a will. Not one. So they had all this money coming in, and all the spouses thought, well, hey, I'm going to get all of this money because it's, you know, my husband died. And, but that's not how it works. In New York and in Massachusetts, and I'm not going to give the numbers because I don't know Massachusetts by heart, but a certain percentage will go to a surviving spouse, and a certain percentage of the estate will go to the children. So then you end up with these minor children getting all of this money. So if you don't want that to happen, you should really think through how you want your assets to be distributed upon your death. So who needs an estate plan? We all do, but particularly people that have a lot of wealth, right, to do the tax planning that we discussed. People with minor children, right? There's all sorts of stages of estate planning, you know, and I have a will and I have all that stuff done right now because I have a 6-year-old and a 7-year-old and a 8-year-old right now. So I want to make sure that there are mechanisms in place so that if something should happen to my husband and to me, that they're, you know, not getting a lump sum of money, which would come from insurance, because I'm worth a lot more dead than I am alive, and so that it's managed properly at our younger stage with children. If you have dependents with special needs, that's a really critical time to think about having some estate planning done, right? Because you want to make sure that the assets are managed properly on that person's behalf. And also, if you have individuals that you would like to get money to and they are on some sort of government assistance, or if they're receiving Medicaid, or if they're receiving some sort of means-tested benefits, you might want to think about maybe using trusts and not giving money outright to people, because that will disqualify certain individuals from certain government programs. You also should have an estate plan if you have children from a previous relationship. We had a lot of these discussions in my practice where you have an individual that will come in and have children from a previous marriage and is on to wife or husband number 2, 3, or 4, and wants to make sure that the assets don't go all to wife 2, 3, or husband 2, 3, or 4, and that money will actually go to the children from a previous relationship, right? Because if you leave money outright to somebody, they can do whatever they want with it. So you may want to think about the form that you leave the money, so that when that person who you leave it to goes on to a better life, dies, then the money can come back to whatever's left, can come back to the minor or to the children from a previous relationship. So you want to make sure you have a hand in how your money is going to be spent, or how it's going to be distributed after you die and after your surviving spouse passes away. You may also, if you have a closely held business, you want to think about how you're going to transfer that business upon your death, or how you're going to fund any buy-sell agreements, or how you're going to manage the transfer of the business between whoever, your partners or the other constituents. And I'm going to talk about that a little bit towards the end, just some general considerations. And one theme that's coming through a lot of these discussions is insurance. So we talked about insurance before, and a lot of the estate planning techniques involve insurance. People that have charitable objectives, you may want to write that into your will, right? So you can leave an unlimited amount of money to charity and wipe out all of your estate tax liability. There's an unlimited charitable deduction in the code, so you can leave as much money as you want. So I've had people that have come into the office that have a lot of money and have a lot of dependents, but they are hell-bent on not paying a single cent of their estate to the federal government or to the state, and if they want to leave, end up leaving a lot of it to charity. And there are all sorts of really creative ways, which are beyond the scope of what we're talking about now, to achieve those objectives. So what are the common estate planning tools? As I was preparing this, I was trying to figure out what would be of the most use in just kind of getting out the major estate planning tools. So what I thought about is I'd talk a little bit about advanced directives, right? So we're going to talk a little bit about healthcare proxies, living wills, powers of attorney, and how that all plays into your estate plan, financial empowerment, ruling your own world, as you said, so that you don't have people making decisions for you. You can actually say who you would like those people to be. I'm going to talk a little bit about wills and some basic concepts with wills. I'm going to touch on trusts. I'm just going to give some basic concepts about trusts. And then I'm going to talk a little bit about business agreements, kind of the buy-sell agreements that I mentioned before. All right, so who in this room has a power of attorney? All right, that's pretty good. Who in this room has a healthcare proxy? That's pretty good too. And a living will. All right, so that's pretty good. So for those of you that have it, I'll reinforce the good reasons why you have it. And for those of you that don't, they are very simple documents. You don't, in New York, you don't need a lawyer to do them. Most of them are on your Department of Health websites, or they're just very readily attainable, and they're very important to have. And I have these pictures on here because oftentimes I talk about these with students, and none of them have these documents, and it's because they think they're not old enough, or they're not going to get sick, or bad's not going to happen to them. But this is what we're going to talk about. We're going to talk real quick about powers of attorney, healthcare proxies, living will, and then I'm going to mention long-term care insurance, because that's another way to protect your assets, right? Because nursing home care is really expensive. Does anybody know how much nursing home care is per month? All right, so you guys work here. Does anybody else know how much is it? No? Take a guess. A month, right? Okay, a month. It ranges in between, I'd say, about $7,000 and $10,000 a month in this area, right?
I spent 12 for my dad in Albany.
In Albany you did, okay. All right, well the Medicaid pay rate is $8,000. So right, so that was private pay. Right, that's a lot of money. So, right, that's private pay. Okay, so that's a lot of money, right? So if you can get some long-term care insurance in place to protect against or defray those costs, at least it helps. All right, so what is a power of attorney? A power of attorney is a legal document that permits another person to complete financial transactions on your behalf. So it's a document, and there's one right under in the Massachusetts laws, in the Massachusetts code, I guess I should say, where you can actually name a person to make decisions for you financially. So if you can either have a springing power of attorney, and that's a document that comes into existence when you become incapacitated, or you can give somebody a general durable power of attorney that comes into existence immediately, right? So there's some pros and cons of both of them. The one that comes into effect immediately, you have to really trust that person, right? So for asset protection purposes, it's probably not the best vehicle, but it's the most efficient vehicle, because if you have a springing power of attorney that comes into effect when you become incapacitated, who has to decide that you're incapacitated? Doctors, right? So the doctor has to make the decision that you're incapacitated. And if anybody's ever dealt with aging parents or aging individuals or sick individuals who don't really have the wherewithal to make these decisions but can't come to grips with it, to get that person to go to the doctor, to get them declared incapacitated, is a big deal, and it causes a lot of problems. And oftentimes bills have to get paid, doctors have to get paid, financial transactions have to keep alive, and oftentimes a springing power of attorney holds things up. It does not permit a person to make healthcare decisions. That's a healthcare proxy, so it's only for financial decisions. Powers of attorney can also be used on a limited basis, right? You have to go away for something. You're going out of the country for a month or two, and you want someone to be able to handle your affairs. You are not going to be around for your house closing. You can have a short duration, but it's something that you should really think about while you have the capacity to make it, right? Because once you don't have the capacity to make a power of attorney or execute a power of attorney or a healthcare proxy, you can no longer sign it, and then there's a whole host of other considerations that come into play.
Can you explain the difference between a power of attorney and a durable power of attorney?
I can. And it depends, because a durable power of attorney is the power of attorney that I believe you have in the Massachusetts laws here, and we have in New York. And a durable power of attorney survives incapacity, okay? So it's a document that when you sign it, it becomes in effect immediately, and it survives your incapacity. Years ago, when we had regular powers of attorney, they did not survive your incapacity, right? So the durable power of attorney, it's durable. It keeps on going even if you don't, mentally, okay? Or if you're not able to. And a power of attorney ceases to exist when you do. So a lot of people think that when mom or dad pass away and you had power of attorney over their affairs, that I can just go to the bank now after mom or dad dies and take care of things. And that's not how it works, right? And it's very frustrating for people. And I'll talk about some workarounds on that in just a little bit. But it's a very simple document, and it's something that everybody should have in their little estate planning toolkit. A healthcare proxy is a document that appoints an agent to make healthcare decisions, right? And that is only when the individual is unable to make them for him or herself. So if mom or dad or somebody is in the hospital and they're unable to make the healthcare decisions, it's a document where you can appoint your own agent to make the agent to make decisions for you. So it gives you the control to say who you would like to make those decisions. My healthcare proxy does not have my mother anywhere near it. So she's on a lot of my other documents, but my healthcare proxy, she is not on any of the documents because she would keep me alive for the rest of my life come hell or high water. So I've decided that the people that I know will make the decisions that I want, I've informed them what I'd want in the event I couldn't make my own decisions. Those are the people that I name. So I took control over who is going to actually be able to talk to the doctors on my behalf. A living will, and I don't believe you have living will legislation in New York, in Massachusetts. We don't in New York. But a living will is a document that kind of supplements the healthcare proxy. And what the living will does is kind of just contains instructions about someone's end-of-life decisions, right? So if you don't want to be on artificial nutrition and hydration, if you don't want all sorts of heroic measures taken, it's a good document to have. It's a one-page document that you can execute. It just kind of says what you want. You want to be at home for your last final days to the extent it won't burden your family. You want to be, you know, completely medicated, whatever you want at the end. And what the living will document also does is it helps the healthcare proxy, right? So if the healthcare proxy, if your agent is having a hard time making the decision on what to do or isn't really sure, right, even though they should be, kind of something in their back pocket to say, okay, this is what she really wanted or this is what he really wanted. And it kind of gives assurance to the family and it just helps. So those are the three advanced directives that are very easy to execute and should not cost a lot of money at all to have in your estate planning toolbox. And what a living will can accomplish, and I just said this, so it works in conjunction with the healthcare proxy. It includes directions as to wanted and unwanted medical treatments. Long-term care insurance, like I just mentioned, is very important to consider. It defrays the cost of long-term care at home, in an assisted living, in a nursing home. And Medicare generally doesn't pay for nursing home care, right? They'll cover a couple of, you know, a short stay in the very beginning. But then you get into the whole world. If Medicare doesn't pay and you can't afford it, bless you, you get into the whole world of Medicaid planning and Medicaid, and that's a whole different discussion that we may do maybe with elder law in the spring. And why consider long-term care insurance? It kind of gives you control of your own assets. You get a choice where you want to receive care, right? Only a certain number of, there's only a certain number of Medicaid beds, right? So only a certain, in facilities, there's only a certain number of places you can go if you can't afford long-term care. Protects your assets, right? To leave more to your heirs after you die with that $10,000, $12,000 bill every month. That can deplete your finances really, really quickly, especially because we have this longevity issue going on in our country, right? And it provides peace of mind. So long-term care insurance is another type of insurance. And of course, the younger you are when you get it, the cheaper it becomes. But oftentimes, it's still worth it. So if you're talking to somebody about insurance, you may want to get a price on that too. And to avoid a possible burden on the family. Oftentimes, people have to chip in to pay for mom or dad or grandma or grandpa or whoever. So that's there, and so let's talk about wills for a few minutes, because that's the next document that you want to have in your toolkit, right? You don't want to have the state of Massachusetts come in and tell you where all your assets are going to go. You want to have some sort of control over who gets your property and how they get it. So these are the primary reasons to make a will that I could think of, to avoid intestate succession, right? To avoid the state coming in and saying who's going to get your property, to nominate guardians for your children. So in my will, I have guardians named for my 2 minor children. To choose a personal representative, that's what you call it in Massachusetts, or an executor or somebody to administer your estate. We call it an executor in New York. To make specific bequests, meaning if you want certain assets to go to certain people, so you have I want to say brooch, I don't know why, because that's in a lot of the case law, but a ring, jewelry, something very special that you want to go to a specific person. I don't know if any of you have ever been involved in an estate, but family members get a little bit different when the matriarch and the patriarch of the family die, or grandma or grandpa or somebody, right? So fights happen over what you would think would be some of the most inconsequential assets in an estate. So if there's something that you know has value, to somebody in your family, or you have a specific way in which you'd like them to get it, or a specific person, make sure you say it. It's very easy to say what you want. If you don't say what you want, someone else is going to decide that for you. People who have small businesses often do wills and put in clauses that grant the executor or the personal representative the authority to continue a business, whether it's during a wind-up period or whether it's to continue going forward for a specific period of time. So that's why people often include language to continue their businesses in their wills. Tax planning, of course, and if I get to it, I still have 30 minutes. So if I get to it at the end, I'll show you some basic kind of tax planning in a will. And that's why people do their wills. And for peace of mind, right? Knowing that you've actually taken care of your affairs to the best you can anticipate going forward. All right, this is really important. And I want to spend a couple minutes on this. And I'm just going to put all of these up here. Okay, property that doesn't pass via a will. So you'll go and you'll make this very elaborate estate plan. You'll think it through. It'll be pristine. It'll be perfect. It'll include all your wishes. But you don't have anything that passes through your will, right? So these are the assets that don't pass via a will, right? They pass by what we call operation of law. Okay, so for example, property held in a joint tenancy, right? You have a bank account with dad and son on it, right? So people say, well, I'm just going to put them on the account for convenience purposes, right? As long as it's not a convenience account, which is different. If it's a true joint account, son can go in and withdraw money, son can put in money, they can take care of each other's affairs through that account. That account is going to go by operation of law on dad's death right to son. It is not going to go through the will. So just say, well, son lives in New York or Massachusetts and he's been taking care of me and he's helping with all the bills, but I really want that $400,000, bank account to go amongst all of my kids. And I said that in my will, right? I split it 4 ways. It's not going to go that way. It's going to go right to the son. In my example, and if it goes right to the son in that example, if the son cares about dad's wishes, son could then go ahead and transfer the assets to his or her siblings, or his siblings in my example, but guess what that does? That's a gift, right? So then the son is now going to have gift tax consequences to that transfer. So it's something that we have to be very mindful of when we are planning our estate plans. Life insurance payable to a named beneficiary, right? My life insurance, my primary beneficiary is my husband. Contingent beneficiaries are my kids. That is not going to go through my will, right? Unless I do something to make it. So for example, what you could do with life insurance is that the named beneficiary could be the trust under your will for your minor children or for whoever you want. But you have to make sure that you actually look at the beneficiary designations and make sure you get those right. People don't pay any attention, or pay very little attention to what the actual beneficiary designation documents say. And it's really important when you're doing this type of work to actually look and see, where is this going to go? Is this going to go through my estate? Then in that case, it will go according to your estate plan, or is it going to go to my beneficiary and anything I say in my will isn't going to matter? Property held in a trust doesn't pass via a will. It passes pursuant to the terms of the trust. Retirement plans payable to beneficiaries, as we talked about, do not pass through your estate. And in fact, for income tax planning, you don't really want your retirement plan to pass through your estate because there are shorter payment periods, payout periods for retirement plans payable to estates. And if you have a shorter period, more comes out, and then there's more income tax consequences. So you have to think about that. Bank account trust, that's payable on death accounts, or Totten trust, things like that, that does not pass via a will. Exempt property I have on here. I don't know if it's applicable in Massachusetts, but it might be, so I'm going to mention it. There's a certain amount of assets in New York, at least, that go right off the top to a surviving spouse and minor children. So in New York, it's things like a car, the Bible, pictures, the farm animals. I'm not sure why that's still, well, I mean, there's a lot of farms in New York, but there's $96,000 of exempt property in New York State that go right off the top and do not pass pursuant to a will. And then there's also the right of election. In most states, you can't fully disinherit a spouse, right? So if you try to leave money to everybody else except your stinking spouse, they can come in and elect against the estate, and there's assets that they can get. So you have to think about that. That doesn't pass via the will. It'll pass right outside of the will. All right, and then trusts, I mentioned a little bit about a trust. And when folks set up a trust, they do it for a variety of reasons that I'll explain in a minute. But really what a trust is it's a person or an institution is going to manage and distribute the funds. So you set up a trust for the benefit of other people, and the trustee will manage the account and distribute the funds according to the terms of the trust. The trust will exist for the beneficiary, it'll exist for the designated beneficiary. So in my example before, I have trust set up under my will to receive life insurance, and they'll be managed for the benefit of my minor children if I were to die prior to the term insurance, some of its term insurance, prior to the term of the insurance. Trusts can be revocable or they can be irrevocable, and that has some tax consequences to it. That I'll explain in a little bit, but the distributions will be made according to the terms of the trust. So it could be that you want to give money in trust to be distributed for, health, education, maintenance, and support. It could be distributed, just all income distributed, principal payments made throughout the year. It's all within the creator of the trust control on how the money gets paid out for the most part. So it puts a lot of power in the grantor or the settlor of the trust, as we call them. So trusts are very powerful tools, and I'm going to tell you why people use trusts. For privacy reasons, a lot of people use revocable trusts in place of wills. And the reason for that is that wills are a public document. You can go down to the probate court, is that what it's called in Massachusetts, and see the terms of a will. A lot of people want to put money in a revocable trust to manage their assets during their life, and upon their death, the assets are just going to pass outside of the will, and nobody will really see the terms of the trust. Sometimes the judges will ask you to see the terms of the trust when you go in to administer an estate, but then you just want to make sure that you can actually bring the document with you when you leave. You want to use a trust for minor children, right? Minor children can't manage their own assets. So sometimes if you have things like life insurance, or if you have any sort of money that would rise to the level of using a trust, you might want to put that money for minor children in a trust. Second marriages, like I said, a lot of times people will put money in a trust or draft a trust in their will. So money goes to surviving third husband for, the duration of his life, and upon his death, the money comes back is paid to, Johnny and Abby from my first marriage, right? To make sure that they get the money and have a trustee administer that property so that it's not depleted during fourth husband's life. Creditor protection, people use trust for creditor protection. There's all sorts of nuances to that, but a lot of people will get money out of their estates during their lives to protect their assets. You'll see that a lot when people have businesses that carry a significant amount of liability. And people who have dependents with special needs, a special needs trusts are set up oftentimes to assist with that type of situation. All right, what else do we want to talk about here? Planning with life insurance. I have some slides on here because life insurance comes up a lot. Life insurance passes to the beneficiaries income tax free, so it's really income tax efficient. But it is included in somebody's gross estate for estate tax purposes, the proceeds. So there's all sorts of planning that goes on if you have a significant amount of life insurance to get it kind of out of your estate, so that it's not included for tax purposes. But, you know, life insurance is a very valuable tool at all different stages of a person's life. So for me, I have life insurance through the time that my husband, well, some of it goes longer, but we've insured ourselves enough until my husband and I retire, and to make sure that if something happens to one of us, we can pay for college or something like that. So we have it in place until those kind of bills are paid off. You'll often see life insurance is involved when there are divorces, right, to fund some of the separation and divorce agreements, and to pay for college and that type of stuff in the event that that mom or dad die prior to those expenses being satisfied. So life insurance is a very valuable planning tool. And like with long-term care insurance, the earlier you buy it, the less expensive it is, but it's also sometimes not that cost prohibitive. So if it comes up in your discussions, you should at least take a look and see how much it would cost for your situation. Irrevocable life insurance trusts are kind of complicated, but just know that you can get the value of the life insurance out of your estate by placing it in a trust, right? So oftentimes people will create a trust and transfer or their life insurance to the trust, or have the trust buy the life insurance on their life. And the money will still go according to the individual's wishes, but the proceeds are then not included in your estate for estate tax purposes. And this is becoming less and, well, not less and less relevant, but less relevant as the estate tax exemptions go up. But it's still something to consider, because life insurance, you know, everyone will look at me and say, well, you really have nothing to plan for because you don't really have that many assets. You know, you have a house with a mortgage on it, and you have 2 little kids, and you know, you have some retirement, but if we both, God forbid something happened to both of us, we could put ourselves in a taxable situation just by life insurance. So it's important to think about how to plan for that. And a lot of people don't think about those types of issues. So you want to make sure that life insurance gets put to good use and goes to the people in the full value that you intended it to. All right, retirement benefits. I think this is 2 slides on this, only because it comes up a lot, and you mentioned it before, Dave. But retirement benefits are subject to estate and income tax. So the value of your retirement benefit is going to be included in your estate, but then when the amounts are paid out, there's going to be income tax associated with the payments out to your beneficiaries. So it's something that people try to plan for, because the income tax consequences can be significant. And then a couple of things that people do with retirement benefits is they name a charity as the beneficiary of a plan, right? Charities don't pay income tax, so that's a good place to put them. Naming your spouse as the beneficiary of a retirement benefit for estate tax plans, right? Doesn't eliminate the income tax consequences, but spouses can transfer as much assets as they want between each other, estate and gift tax free. So that's one thing you want to do, and especially if you have a plan that's governed by ERISA, right, by the federal rules, you have to leave your money to your spouse, right? So there's pretty strict rules on who you can leave your assets to. Then I say don't name the estate as a beneficiary with retirement benefits, because it increases the income tax liability associated with them. And I can leave you guys with this slide if you want, because just in case it's helpful, all of them. Buy-sell agreements for any of you guys that have any sort of small businesses. You know, how are you going to fund, right, the buyout if one of the owners dies? Right? How are you going to continue that business, right? If one person in the business is kind of the revenue generator of that business and that person dies, what's going to happen to that small business? So a couple of things that we do is we use life insurance, but there's 2 types of buy-sell agreements. One's a cross-purchase, so the owners purchase from each other, and the other is a redemption agreement where an entity is going to redeem an owner upon a specific event. But how are you going to pay for some of this stuff? So a couple of things that I put up here is, one, self-funded, right? You can self-fund the buyouts. That's really hard to do. So, and I put a credit card there that's on fire, because that often is really hard to do, and I'm not sure that's the best planning tool, although it's something to consider. And the other is life insurance, right? So a lot of times when small business owners get together, they'll buy life insurance on each other to fund, you know, the death of one of the members of the business to fund either a buyout or to continue the business or however it goes. But it's something that you should really think about because a lot of times what I've seen in my practice is, you know, we have a small business owner, couple of people involved, and small business owner dies and the business dies with the small business owner, which wasn't necessarily the intent. So planning for that is prudent. Estate tax issues with small businesses is liquidity, right? So that's the big thing. How are we going to pay any estate taxes involved? And then we have valuation, right? So how are you going to determine what the value of the business is for estate tax purposes? And there's all sorts of economics that you guys probably understand better than I do. But there's all sorts of valuation procedures that are used to to get help with planning for estate planning for a small business. I mean, there's a whole bunch of different professionals that could get involved. So generally there's a team, I would say, and the different prongs to the team, and correct me if I'm wrong, would be a lawyer, a CPA, and a financial advisor, insurance agent type. Do you agree?
Certified
financial planner, right? Yep, and a CFP. That would be a great. Yep. Yep.
If you were to want to put a team together, where would you start? Would you start with a financial advisor, maybe?
Well, it depends. It depends who you have a relationship with. So I think. So what we used to do in my practice is we would, you know, if somebody came to me, the lawyer, I would then say, okay, well, this is who we need to get involved, right? We go to the accountant, and then we'd go to the insurance person. But if you have a relationship with the financial advisor, then you can start there and say, can you help me build my team? And then, you know, but interview people too. Interview the lawyers, right? You know, right? Make sure that you interview a whole bunch of people. But that's the way I've approached it in the past. And so I think I don't think you can go with any one member of that team. I think you need to get a couple of people involved. Okay, and here we go. Methods to pay estate taxes. Cash, liquidate assets, oftentimes that's not an option. Borrow money, pay in installments. There's actually a code section for small businesses that allow you to pay estate taxes associated with a non-liquid business over time. And that's the section if you're interested. And then estate life insurance is the big one. What else do I have for you? Basic tax planning tips. I've already told you about the federal estate tax exemptions for 2013, so I won't bore you with it again. This I have up here just as a point of reference, because I think this is interesting. So we had this whole Taxpayer Relief Act of 2012, and that came into existence just in January of 2013. But if you look, oh, no. Sorry. Where's the pointer? Where's the pointer? In the middle? Okay. Oh, there we go. Okay. So these are the Bush tax rates, right? So remember all the Bush tax cuts that came into existence in 2001? This is what the federal exemption looked like going forward. This is what it was supposed to look like. It started at $1 million, right? That's the $1 million that we have. Now we have $5 million. And it went up until 2009 to 3.5 million. And then it was supposed to be repealed in 2010. And there was an awful name for this legislation here. It was called Throw Mama from the Train legislation, right? Because in 2010, everyone was like, there's no tax liability. Guess who died in 2010? Yes, George Steinbrenner died in 2010. So that was fascinating. So for the whole year of 2010, up until the very end, there was no estate tax. But Congress, in their infinite wisdom, came in at the very, very end and created an estate tax that was retroactive. And had the exemption levels that we're dealing with now, and that's why it was made permanent in 2013. But I just wanted to give you some historical perspective of what life has looked like for federal estate tax exemptions in the last 10 to 12 years. You don't need, that's the estate tax calculation. You could take a look at that on your own if you want to, but this gross estate includes everything. People think, well, if it didn't pass under my will, it's not included in my estate for estate tax purposes, and that's just not true. Okay, so pretty much anything you have your hands in right now is going to be included in your gross estate for estate tax purposes. Things that you don't even know you own are going to be included in your estate for estate tax purposes, right? And all these things are added up to get to that $5 million exemption level for the federal and the $1 million for the state, right? So these are all the types of assets that are going to be included in your estate. And you can take a look at those. I gave some references if you want them. If not, you can disregard them. And the major deductions that I put in here are transfers to charitable public uses. So really the charitable deduction, Section 2055 of the code gives an unlimited charitable deduction for estate and gift tax transfers to charity. So, well, actually it's 2055 for estate, it's 2522 for gift. But anyway, you get the point. Bequests to surviving spouses, you can leave an unlimited amount to your surviving spouse, and there's no tax on the transfers until they leave the marital unit, right? So until they leave. And then you get a credit for state death taxes payable on your federal return. But those are the three big ones, but the two biggest being the charitable and the marital deductions. A couple things you can do to plan during your life is that you can give your assets away. Most people don't like that option. But if you have enough assets, you can give them away during your life, so to decrease your estate upon your death. So I mentioned two of the gift tax exclusions, right? So if you give something away during your life, you have to deal with the gift tax exemption. Okay, but there's two things that are of use to us right now. And one's called the gift tax annual exclusion. So I can give $14,000, assuming I had it, to each one of you in this room every single year and not run up against any gift tax issues. My husband and I, because we're married, we can give, that goes without implication, right? It's $28,000, so you can double it for spouses. You can also, there's also an exclusion, oh, it's terrible.